Imagine just a year from now, you are taking a look back at your trading history, and what you see is a solid track record of smart and well thought out decisions that have significantly boosted your trading success. And you might wonder, how did I make such a leap? Well, it's because you made a pivotal change. Instead of jumping into the trades based on a gut feeling, you began with a commitment to methodically evaluate each trading opportunity that comes along your way, following this 5-step checklist I'm about to show you. So the very first step in our 5-step trading checklist is to identify the overall market trend using price action analysis. So for example, as a trend trader myself, I'm always on the lookout for markets with a clear trending behavior. So for example, if the uptrend is forming, you will see a series of higher highs and higher lows being formed, while in the downtrend, you will notice a lower highs and lower lows being formed. And these market structure patterns are very strong indicators of a trend already. So this should be like your first green light to consider for a potential trading opportunity later on. But for example, if the market is non-trending, so it's in a consolidation like it is here on Euro-US dollar 4-hour chart, you will see this kind of boxed in effect. So the price action is currently stuck in the box and is creating nearly equal lows and equal highs. So in this case, many traders will be on the lookout for the breakout and then will decide what are their next moves. So if the price breaks out towards the downside, they will be looking to sell. On the other hand, if the price breaks out towards the upside, they would be looking to buy. So this is why it's super important to analyze the market trend and see where the current price action is sitting, because this distinction will influence every single decision that you will make later on. So before you even contemplate entering the trade, make sure that your trading strategy is in alignment with the overall market trend. And this is actually where you can implement the top-down analysis. So here is a very quick example using top-down analysis to identify the overall market trend, and this is AUD/JPY on the monthly time frame, so we can clearly see that the market is in an uptrend. And the market is in an uptrend because we can clearly see the highs, the higher lows, higher lows, and this is the new high being formed. So what you essentially want to do next, once you confirm that on the monthly, you want to go down to the weekly. So once you are on the weekly chart, you kind of want to confirm the same market structure. So if you're seeing higher highs and higher lows being formed, it means that the long-term trend is holding up and you are kind of confirming that the bullish momentum is still here. So when you get to the daily chart, your goal should remain the same. So you kind of want to check if the same uptrend you saw on the monthly and the weekly are still intact based on the recent price data. And of course, on a daily, you will see a smaller movements going on. So for example, we can see that the new high was created over here, the price pulled back and is currently has formed a higher low, which is absolutely okay. So once you confirm that, you can go onto the lower time frame. So you can go to the 4-hour, 1-hour, it really depends on your trading style, and confirm the same thing you saw on the monthly, weekly, and the daily charts as well. Okay, so the step 1 is done. So we have a chart that is currently trending in the same direction across multiple time frames, following the top-down analysis. Now the next thing you want to do before entering the trade is to mark your support and resistance levels along with the trend lines based on the recent price action data. And trust me, there is the right and the wrong way to do it. So let me explain that. So you have probably seen it before, traders with charts so full of lines that it looks like a toddler scribble. And I was one of them in the beginning of my trading journey, because you kind of have your support and resistance lines everywhere, trend lines crisscrossing, you have moving averages, Fibonacci's, you name it. And this can actually lead you to analysis paralysis. So here's my 2 cents on how to avoid that. So I keep my trading charts as clean as possible by focusing on 2 the most significant support levels below the current price and 2 resistance levels above the current price. That's all I need, and that's what I highly recommend you to do and focus on. on. And when it comes to the trend lines, remember that it's not about having a dozen of them crisscrossing each other. In reality, you just need 2 of them. So the one should be on the higher time frame and the second one should be on the time frame you are using as your entry. So take a look at this Euro NZD chart, and this is a perfect example of how just a coupled, well-placed, trend lines and support and resistance levels can speak volumes. Okay, so right at the top we have daily resistance, and this is where the price has been repeatedly failed to break through, indicating a strong selling pressure. So moving down, we have the 4-hour resistance level just over here, because we see these multiple rejections of this level, once again indicating strong selling pressure, and the buyers were not able to break through. We also observe the downtrend that was recently broken, so we can see with this nice bullish pressure, so the market has been shifted from the downward movement to the upward, clearly indicating that the buyers are kind of gaining control. We can see that this was the resistance level because of multiple rejections, but since it was broken, now it stands as a support. Now the second trend line was just over here, so this formed some sort of a downtrending channel, and it was rejected by the daily support. So you can see how just having the key zones and the trend lines can give you a clear picture of what's going on with the price. So right now the price is currently navigating between the 4-hour resistance and the 4-hour support. So of course, we as the traders, we always monitoring what the price might do next. And we might see if the price will hold around the support level, we might seeing a potential upward momentum to maybe retest the daily resistance as it happened before just over here. If the support will not hold for any reason, we might see a downward movement. So what I'm trying to highlight with this chart is the critical importance of key levels and trend lines, because they are not just guides, they can actually tell you if you are entering a high probability zone, or maybe you are approaching a point of a turnaround. Okay, so once you're done identifying the overall market trend, key levels of support and resistance, and trend lines, the next thing we're gonna do is talk about confluence and confirmation. So picture confluence as some sort of gathering all of your evidence before you entering the trade. So you're not just relying on one support level or one signal, you kind of look for other technical signals that will pinpoint in the same direction you are looking to enter. So for example, you see that the price is approaching a well identified support level. So this would be your first kind of layer that the price might bounce back off this level, indicating you a potential buying opportunity. So next, you decide to add the moving average to the chart. So moving averages, they work brilliantly as a dynamic support and resistance, and once you add it to the chart, you see that the price action intersected with the moving average as well, which actually gives you the second layer of confirmation and confluence. And the actual beauty of confluence lies in its ability to boost your confidence in a trade. So the more confluences you have, the better and the higher probability of your trade to succeed in your favor. So just to show you guys how the confluence and confirmation works in real action, this is USD CAD on a 4-hour chart, and this is the trade I sent to my VIP members. So in this case, I had 3 confluences. So the first one was a rejection of an uptrend, the second one was of the 50 moving average, and the third one was a closure of a bullish engulfing candlestick. And as you can see guys, by combining these 3 confluences that signaled me a bullish pressure, I was able to profit 99 pips in the total profit at the moment. Okay, so we navigated through the identifying the overall market trend, key levels of support and resistance, and the trend lines, confluence and confirmation. And the step 4 that you should check before entering every single trade is your entry and exit strategy, along with the risk reward ratio. And this step is critical for any trading strategy in any market that you will use, because it sets the parameters for you not to blow your account in a single trade. So your entry point is the trigger that will initiate the trade, and it should be based on a solid price action analysis that aligns with your trading strategy or a trading plan. So once the entry point is determined, equally important is your exit strategy. So this includes setting the take profit level with the aim to exit the trade with the gains, and the stop loss to limit potential losses. And these levels should be set based on thorough assessment of the market's current situation, and of course your risk tolerance, because as you know, we all have different ones and there's no one size fits all. Also, I have a very great tip for you, so make sure to assess the trade's potential for profit. profit. Ensure that there is enough room for the trade to move in your favor before it hits any key level or the trend line or whatever price action you analyze. So for example, if let's say we have euro US dollar and the current price is away from the next key resistance level around 60 pips, then of course it will be easier for you to calculate your lot size, where to exit your trade, where to set your stop loss, and what's gonna be your risk to reward ratio. So make sure to do that because it will help you in the long run. So here's a quick example once again, and I will be using my VP trade just because I want to show you how I implement the exact same technique I'm teaching you guys. So this is ANZDJPY on the 1 hour at the moment, and this trade was sent on the Valentine's Day. So let's talk about the date with the charts, So the reason behind this trade was super simple. So as you can see, we had this sharp move towards the upside. Then the price got into the channel, which actually formed a bull flag chart pattern, which is a bullish continuation pattern. And then as you can see, we had some sort of small consolidation before the breakout occurred. This was the entry candle just over here, so I always enter on the 4-hour candlestick closure. So the reason I'm showing you this trade is because when, for example, you trade the bull flag, in order to measure your potential profit, you have to measure the flag ball, so just around here. So I think it was around 170 pip move, so it actually aligned with my risk to reward ratio because I'm usually trading with 80 pips as a stop loss and 160 for my final profit target. And as you can see, this trade moved actually where exactly it needed to, and I had my higher time frame resistance level marked over here. So of course the trade moved way more than 160 pips, so I just had to close it manually because it's just hitting resistance and I don't want to lose my money, so I closed it manually and I was happy. So what I was just trying to say, that as you can see, I also have key levels drawn on my charts, and I was aiming for that monthly resistance zone as well, and it actually aligned with my risk to reward ratio. You can see my stop loss is being covered by the support of the lower time frames that I identified. Of course, the flag measure was just another good additional confirmation of where I should aim and close my trades. So I'm not sure why trading is doing this while I'm filming, but that's absolutely okay. So moving on to the step 5, this is the final thing that you should do before entering the trade, is to check economic calendar. And it doesn't matter which trading strategy you trade, which market you trade, stocks, crypto, futures, it does not matter. Always check the economic calendar. So I always use fxtraderkristina. It's simply because they have a very good label system. So for example, red, it will be very high impact news. Orange is the medium one, and yellow label, it means there will be low volatility views and probably not gonna move market as much as the red label ones. Of course, while it's not foolproof and there's always exceptions, but we also have to keep in mind that apart from the news, there's always something else going on in the world, such as natural disasters, the war, but the news that you see on websites such as fxtrader.com, Forex Factory, and all the other ones, it sets a pretty solid foundation for you to anticipate market movements. So always check that before you enter the trade, because it will save your account in the long run, and it will help you to stick to your trading plan or a trading strategy to not blow your account within a single trade, as I said. So if you found this video helpful, then definitely drop me a like, and if you have any question regarding to trading psychology, trading tips, or trading strategies in general, then definitely let me know in the comment section down below, and never ever hesitate to reach out to me, because I will do my best to help you out in any way possible, just to make your journey simple but effective. But if you want to watch more of my content, I will leave a card just over here so you can click and watch it next.